So I want to show you two different ways to value options. I want to talk about how to value options by price. This is the novice way. This is the way everybody does it. And when I say everybody, I mean 99% of the folks out there that are option traders will look at an option and say, this is cheap. And 99% of the time, they're wrong. Then I want to show you how to look at it like a pattern trader, which is by valuing options by range. You might think, well, what is range? Range is, there's a high price, there's a low price. It's a little bit more than that. That's a little bit simple when I say that, but I'm going to show you exactly how we do this. And I want to talk about summer's cheap options. We're going to take a look at the top cheapest options going into summer right now. So that's my plan for you here. Let's talk about options by price. So when we look at options by price, here's an example. I'm looking at Nike, symbol NKE. Now, if you take a look at Nike and you see what it's done in the last couple of months, it's pretty much moved sideways. You see lows here on this image down here around 42.50, and you see the highs up here, close to 47.50. All right. You might go back and say to yourself, well, you know what? Maybe if I look at a slightly out of the money call option, here's a $50 call option going into July, mid-July. It's a 30-day call option. And it's priced for really like $1.21 right down the middle. So $1.21, you multiply that times 100, and that's what you're paying for the call option, $121. All right. That's actually the price of a good meal. You might immediately say to yourself, that's cheap. That's a cheap option. And, you could be looking, if you really look down here and look, really into the low end of this spreadsheet, you can see the 60-cent calls even get cheaper. But now, what we're doing? We're judging options by simply the price themselves, and not by the things that really make an option cheap or expensive. And the number one thing that I look at to make an option cheap or expensive is something called extrinsic value. Okay, extrinsic value is the time value only in the option. Now, what makes an option's time value cheap or expensive? Well, there's several different things. Interest rates could be part of that. Days to expiration could be part of that. The strike price itself could be part of that if it's in, at, or out of the money. The other thing that makes a big difference on the price of an option is the volatility surrounding that option, the implied volatility surrounding that option. And so when you look at an option and you look at it by price, you are missing what 99% of you are missing the one key factor, which is implied volatility. That factors in all those things, all right? All those things that really help us determine whether an option is cheap or expensive. So, you know what I'm going to tell you right now? Nike is not a cheap option. Nike is an expensive option, because what we do is we look at options as pattern traders. I look for patterns of option prices being cheap or expensive. So I'll take a look at a 1-year chart of the underlying. In this case, I look at the 1-year chart of Nike. And what we do is we value those at-the-money options. Now, an at-the-money option is going to have the most time value and still have zero real value. So I look at those at-the-money calls and I look at those at-the-money puts. And we're able to reverse engineer those and add a value to it using options pricing software. And if I take that value each day and I mark that value like the close of a stock, if you look at the close of a stock and you get that close of that stock each day, you're getting a chart. That's what you see on the screen here next to me, a chart of Nike. I also can chart based on that time value. All right, based on that time value and reverse engineering that to what we call implied volatility, I'm able to chart that value each day, and I can create a chart of that. You can see that right here in this red line. And it shows here going back. If I go back, some time, I can see the highs that option is traded for in value in that implied volatility, and I can see the lows that option is traded in implied volatility. And then I can go see, well, where is it now? And it all of a sudden becomes clear. It becomes clear as day. If I'm looking at today's implied volatility, I can immediately see, well, where is it relative to the 1-year high and the 1-year low? And if it's near the 1-year high, then it's expensive in the range. If it's 1 year's low, then it's cheap in the range. Okay. Here are the top 5 cheapest options this summer. That means call options and put options on these 5 stocks. I find it interesting when you look at this. All right. You got O'Reilly in there. You've got Netflix. You got Kohl's, Target, and I believe it's Salid, the last CE down there at the bottom. All right. What do these have in common? Well, that CE at the bottom is a tech company. So the only tech company that I know of is cheap right now. So they're more of a tech manufacturing company. But then if you take a look at O'Reilly, Kohl's, and Target, that's all retail. All right. And of course, Netflix, entertainment. All right. So if I'm looking at a summary on my cheap options, let's do this, folks. Number 1, let's avoid the trap of thinking that just because an option's cheap and looks cheap doesn't mean that it is. Okay. Number 2, let's measure and let's start to measure the options implied volatility. That's the real value, the real level of value of the market, of the options market against this 1-year range. Because if I got an idea of, with my today price, what's the highest it's been in the last year? What's the lowest it's been in the last year? And where is it at right now? I can get a better gauge on whether that option is truly cheap or expensive. Okay. And then number 3, traders, they're using this measurement with their own tools. You know, maybe you use the same tools I do. Maybe you use seasonality. And you're going to take a look at Target. You're going to take a look at KSS. You're going to take a look at O'Reilly. And you're going to go in and maybe look and see, well, is there a seasonal bullish pattern that's happening right now with these 3? Because if it is, I might want to look at call options on it. Or if there's a seasonally bearish pattern that's happening in the retail markets, maybe I might want to start looking at seasonal bears.